All right, thank you for joining. It's 11:30. We'll go ahead and get started. So I will turn it over to Taylor to discuss how wealth actually transfers.
Thanks, Jenna. So if you haven't met me before, like Jenna just said, my name's Taylor, and I'm a financial planner here at Jessup Wealth Management. For today's webinar, we're going to be broadly kind of talking about estate planning, but we're specifically going to focus on what a will or a trust may not necessarily control, how certain types of assets are really passed on to the next generation and why that structure really matters from a tax perspective. And then we're also going to be talking about just building a legacy for future generations, charitable giving strategies, lifetime giving strategies, estate tax. So we're going to be hitting a few different topics today. But first, we're just going to focus on what a will or trust may not actually control. So we're going to start off with kind of a simple topic. It's called contract law, also commonly known as a beneficiary designation. So all that contract law really means is it's just a legally binding agreement between you and a financial institution that dictates who your assets go to upon your passing. And a beneficiary designation does completely supersede a will. So you can have one person listed as a beneficiary in your will and somebody completely different actually listed on an account. And at the end of the day, whoever is listed as a beneficiary on the account, that is who your money or that account will go to. And this is a really important distinction because most likely some of your most highly valued assets are going to be things like an employer retirement plan, so a 401k or a 403b, which those eventually roll over into a traditional or a Roth IRA. So accounts that you've literally been saving your entire working life into. Life insurance policies and annuity contracts also have the ability to put beneficiaries on those. So it's just very important to kind of understand that these are separate and supersede whatever instructions are in your will. Some common issues that I see regarding beneficiary designations is number one, those designations just being very outdated. So anytime you have a major life event like a marriage, divorce, birth of a child, it's just very important to kind of stay on top of updating those designations. It can be easy to forget. But another issue I do see kind of often is naming a minor child as a beneficiary. So legally, obviously, minors cannot manage accounts if they're under 18. So if you do list a minor as a beneficiary, and let's say you do not have a will in place with a guardianship clause, then essentially the state decides who manages that money for that child. So I definitely recommend having a will for that guardianship clause because most likely, you want to pick who manages their inheritance. Another mistake I see is simply naming your estate as the beneficiary. And what this does is it forces that asset to go through probate, and your executor does have to pay administrative costs. funeral expenses, taxes, and potentially creditors, and whatever is actually left over then flows to your beneficiary, either via your will or state intestacy laws if you don't have a will. So never recommend naming your estate directly as a beneficiary. And then the last common issue I do kind of see is not naming contingent beneficiaries, just not having those on file. So your primary is kind of first in line to your accounts, and the contingent is going to be second in line. So if, for example, something happens to your primary and maybe you just never update that designation, if you don't have any contingents in place, then that money will also just go through probate instead of going directly to that person. So very important that you have both of those designations set up. I also want to talk a little bit about how ownership structure impacts the way that your assets move on to the next generation. So there's four main ownership structures I'm really going to touch on. The first one is sole ownership. I think this one is fairly self-explanatory because this type of property is just owned by one person. So it does not automatically pass to anybody unless you do have a will. Then, of course, that asset will pass according to your wishes. Still has to go through probate. But obviously, if you don't have a will, goes through probate and the state decides who gets that. Now, you may have heard the term joint tenancy with rights of survivorship. Sometimes we might see a brokerage account or individual account, whether that be an investment account or a bank account, opened up jointly. So this is essentially when two or more people own equal shares of that asset or of that property. And when one owner passes away, their share automatically transfers to the surviving owner, regardless of what is written in a will or maybe even a trust document. So a joint tenancy with a survivorship does completely bypass probate. We also have tenancy in common. This ownership structure is kind of similar to the joint tenancy with rights of survivorship, but tenancy in common is also when two or more people own property, but they don't necessarily own it in equal shares. So if you have a business and there's two owners, maybe one owns 75% and the other owns 25. But with the tenancy in common ownership structure, when one co-owner dies, that share or their share becomes part of their estate and does pass through probate. So it doesn't automatically go to the other owner of the company or of that property. So I think that's the one really important distinction between the rights of survivorship and then just the tenancy in common. The last most common ownership structure is going to be tenancy by the entirety. This is essentially for married couples. It's only available for married couples, and this couple is treated as a single legal entity. And so upon the death of one spouse, obviously the other spouse would automatically get that property without going through probate. A couple other ways that assets can pass, kind of gearing away from the ownership structure. You may have heard of a term payable on death or the term transfer on death. Anytime you hear these terms, it's basically just signaling to you that there's a beneficiary on file. So a POD is specifically for checking accounts, saving accounts, CDs, and money market funds, whereas a TOD is for brokerage accounts, investment accounts, a primary home, or vehicles. So again, adding a POD or a TOD onto any types of these assets, you're basically adding a beneficiary and it does completely bypass probate and just goes directly to your heirs upon your passing. So this is just a summary of kind of just the last couple slides, just summarizing all the assets that do automatically go through probate. So again, anything without a beneficiary, anything solely owned, tenancy in common property, any assets that are explicitly left to your estate, along with any personal property, and then anything listed in your will is automatically a probate asset. Now, transitioning a little bit into just some of the most common assets that are typically passing on to the next generation. It's really important to, choose who these assets or accounts are going to go to, but I think it's equally important to understand how that actually does pass on to the next generation, and then any tax advantages or consequences kind of associated with that. So I'll be talking a bit about a primary home, taxable accounts, retirement accounts, because that's where a majority of your wealth most likely will be. And then life insurance, of course, is another very common one where that death benefit just goes directly to the beneficiary, as long as one's listed. But we'll focus on the primary home first, and I'll kind of walk us through an example. But a big advantage with passing on a primary home to, let's say, your kids, is that your heirs receive what's called a stepped up cost basis. So basically, when you pass away, whatever the fair market value is at the time of your passing essentially is what the kind of the payment amount is on the kid's side. So we'll go through an example on the right, but another advantage is that inherited assets, specifically talking about a home or a taxable account, automatically qualify for long-term gain tax treatment when sold. So you have your short-term gains, which is anything owned for less than a year, and long-term is anything owned for more than a year. And those tax rates differ between the short and the long. So just another advantage to your heirs or that next generation. So just kind of walking through an example, let's say you purchased a home in 2005 at around 150 grand and you passed away in 2026 when the fair market value was around 325 grand. Your heirs receive that stepped up basis to 325, kind of again saying that's what they paid for the property, not the 150. And then let's say your heirs go ahead and sell that home for 335. This means they only pay taxes on that $10,000 capital gain, not the difference between the 335 and 150. And again, that would be considered a long-term tax position. So you would either be paying 0%, 15%, or 20% in capital gains tax on that 10 grand. And taxable accounts are actually structured the exact same way. Taxable accounts also get a stepped up basis as of your data passing. And I definitely think that there's more of an advantage, more of a tax advantage with the taxable accounts compared to maybe a primary home. So this example we'll kind of walk through, it's going to focus on Apple stock. That's where all these numbers are coming from. So this is not a recommendation for or against Apple. I'm just using this as an example. But back in January of 2005, January 5th, let's say you bought about 100 shares of Apple. At that time, it was $1.15 a share. So your cost basis would have been about 115. Let's say fast forward to June 1st, 2026, you pass away and this Apple stock goes to your son. Well, after all of the stock splits over the last 20 years, those 100 shares are actually about 5,600 shares. And as of June 1st of this year, Apple was priced at a little more than $306, which means the total value would have been a little more than about 1.7 million is what you would have passed on to your son. So because of that stepped up cost basis, he can turn around and sell this $1.7 million of Apple stock and really hardly have any gain. But in this example, let's say that he sold all the stock on June 15th of this year. Technically on June 15th, the stock was priced at a little more than $296. So technically there would be about a 55 grand capital loss. And you can deduct up to $3,000 every year in capital losses against your income. If you have more than that, so in this example, he has 55 grand, you can carry that forward to the next year and then the year after that. Or if you have any large capital gains, these can offset. The gain and loss can offset each other. So huge advantage for, that beneficiary versus if we look at the right-hand side, let's say you were still here, you didn't pass away on June 1st. Your stock as of June 15th again would be worth about 1.6 million. If you sold all of that as an original owner, no inheritance here, you'd have a 1.6 roughly $1 million gain, and you would very easily owe at a minimum a couple hundred grand in taxes just from selling this Apple stock versus it going to your beneficiary. They get that stepped up cost basis and then the automatic long-term gain tax rate. So just a really, really good advantage for the next generation. I also want to talk a little bit about retirement accounts and how that is treated going to the next generation. So I'm specifically talking about your tax-free accounts, so the Roth accounts, and then pre-tax accounts, so 401k, 403b, traditional IRA, those are the most common. So retirement accounts are subject to a 10-year distribution rule. Essentially, what that means is these accounts, when they go to your beneficiaries, do have to be completely depleted within 10 years of your passing. Now, this only applies for non-spousal beneficiaries. If a spouse inherits a retirement account from their spouse, then they can treat it as their own account. There's no special rules. But if your kids, for example, are inheriting an IRA, then they have to deplete that account within 10 years. Now, one important distinction is that the pre-tax retirement accounts do have an annual RMD, or required minimum distribution. So they have to take money out every single year for those 10 years. With my experience, it's typically not a large amount unless the account is fairly large. Um, but I would say those annual RMDs can be anywhere between 2 to 4 or 5% of the account value every year. But these accounts, when they go to the next generation, they will most likely still be invested and still growing every single year. So if you're just taking the minimum RMD every year and just kind of pushing everything else out to year 10, that person could have a really large tax bill in year 10. So I recommend on the pre-tax accounts withdrawing about 1/10 of the account year 1, 2/10 of the account year 2, and kind of so on, so forth. It doesn't matter as much for the Roth accounts because the Roth accounts are tax-free. So for that, I just recommend kind of letting it sit and doing that withdrawal all in year 10, just to give the tax-free assets more time to accumulate. But definitely just something to keep in mind if you have fairly large pre-tax accounts, that your beneficiaries will have these type of taxable distributions in a fairly short amount of time. All right, next we're going to be talking about legacy building. So specifically, we're going to talk a bit about estate tax, really what that is, how it's calculated, why it's important. And then we're going to be talking about some strategies to reduce your taxable estate. So we'll be talking about lifetime giving, qualified charitable distributions, or QCDs, donor advised funds, which is another form of charitable giving. And then we'll also talk about why having a trust can be really helpful. And then we'll focus on charitable trust types as well. So first we'll just talk about estate tax. So essentially this is just a levy on the transfer of a deceased person's assets that exceed the federal estate tax exemption. So a federal estate tax exemption is basically the value of your estate, kind of like the limit your estate can be before it starts to get taxed. So in 2026, as an individual, your estate can be worth about $15 million before you even pay any estate tax. And for married couples, that limit is about $30 million. Now, these limits are very high, but they haven't always been this high. So the Tax Cuts and Jobs Act of 2017 actually raised this federal exemption from $5.49 million in 2017 to a little more than 11 million in 2018. So ever since 2018, this estate tax exemption has kind of gradually gone up, but that doesn't necessarily mean that will continue to happen. we could be 10 years down the road and it could go back to like 5 million or 6 million, 7 million, much, much lower than where they're at right now. So this probably won't affect a lot of people now because the exemption is so high, but again, that could definitely change over, the next few years. So what exactly is included in your taxable estate? I mean, it's essentially everything that you own. So any financial accounts, any life insurance proceeds, but the life insurance proceeds I want to point out are only includable in your estate if you are the owner on the policy and the proceeds are payable to your estate. So this is an example where if your beneficiary was your estate, this would be included in figuring out if you owe estate tax on this money. Any retirement accounts, personal property, vehicle, any business or real estate interests, all of that is kind of included in calculating your total fair market value of all of your assets. Once you have that number, there are a few allowable deductions that can reduce that asset value. So any outstanding debt and any liabilities you have are deductible. Any funeral, administrative, and any probate expenses are deducted from your asset value. Anything left to a spouse. So there's something called an unlimited marital deduction, which basically just means you could leave everything to your spouse, and anything left to your spouse is deducted from your assets, and you might not have any taxable estate. And then anything left to a charitable organization also reduces the value of the assets you own. So once you figure out those deductions and subtract that from your assets, you have to add back in any prior taxable gifts, which most people don't have any prior taxable gifts. But after that's calculated, if then you are above that estate tax exemption or that $15 million, anything above that is when you pay a tax rate of up to 40%. So definitely, don't want to go over that and start losing or paying tax at that type of rate. But there are a few strategies you can implement if you are concerned about being close to that limit or maybe going over. I think the simplest strategy is just lifetime giving. So this year in 2026, you can give $19,000 to an individual, and you can do that for as many people as you want. You just can't do more than 19 grand on one person. If you're married, then as a married couple, you can give about 38 grand. If for some reason you go above that 19 grand limit, what happens is you essentially have to report it to the IRS on Form 709. However, just because you are reporting it doesn't mean you actually owe any gift tax on it yet. So your lifetime gifts have to exceed that federal exemption amount in order to actually owe anything gift tax wise, but you do have to file Form 709 to at least document that as time goes on. So again, since those exemption limits are so high, probably not an issue for most people, but again, that could change. Now, there are certain circumstances where that gifting limit does not apply at all. One of those is going to be medical expenses, so any payments made to a hospital, doctor, or health insurance provider. Any educational expenses, but the payments do need to be made directly to a qualifying educational institution, and this is for tuition only. This does not include books, room, or board. So I see this very common when, maybe a grandparent wants to pay for their grandchild's education. That money would have to be sent directly to that educational institution and not to the child or the parent themselves. Spousal gifts, anything transferred to a U.S. citizen spouse, does not adhere to the gifting limits. And then also any charitable or political donations do not count either, or do not adhere to those limits. Next, another strategy is a qualified charitable distribution, or QCD for short. This is basically just transferring money from your IRA and sending a check to an eligible 501c3 charity. Now, to be eligible for a QCD, you do have to be at least 70 and a half, and the annual limit that you can, I guess, donate is 111,000 per individual, or 222,000 for married couples. So I think where the real advantage is with this is if you are of RMD age, which for most people, that's 73, because RMDs can be very large, and sometimes you may not need all that money that you are forced to take out every single year. So if you're forced to take it already, but maybe you are charitably inclined, whatever you don't need that you really don't want to pay taxes on, you could donate via a QCD. And whatever amount you donate, it's not necessarily a deduction, but it's just not included in your income. So if your RMD is, let's say, 100 grand, maybe you only need 50 grand for your living expenses, but you have to take the other 50 anyway. You can just donate that extra 50 grand, and it's just not included in income, whereas it would have been if you didn't do a QCD. And this specifically can be really helpful if you are facing any Medicare premium surcharges. That's also called an IRMA surcharge. Or if you're trying to keep more of your Social Security tax-free, this is a good option too. What I see is kind of the most common is maybe if you regularly give to a church every single Sunday, chances are if you're just giving cash or writing a check, you're not getting any type of tax benefit from that. But if you are giving via a QCD, then you are getting that tax benefit. So just another way to kind of maximize your income and minimize your taxes there. Kind of sticking on the charitable account topic, there is something called a donor advised fund, or DAF. This essentially is also just a charitable giving account, but it's sponsored by a public charity. So again, the QCDs are specific for IRAs, but a donor advised fund is its own separate account solely for giving to charity. So whatever contributions you make to the donor advised fund are completely tax deductible, so you get an immediate deduction there. Even if the money doesn't necessarily go out to charity like that year, whatever year you make contributions to a donor advised fund, that deduction is available that year. And the contributions or the money is invested and it does grow completely tax-free. So where a donor advised fund might be useful is, let's say you typically itemize your deductions, or maybe you know your income is going to be a lot higher this year and you're just looking to kind of lower your income, or again, just get assets out of your estate because you're worried about estate tax. You can essentially donate to this fund in 1 year, but maybe donate an amount that you would have over several years instead. You can bunch multiple years of donations into one single year to get that bigger charitable deduction. So contributions to a donor advised fund are considered an itemized deduction. So just something to keep in mind. You would have to give, I mean, for it to make sense to do an itemized deduction, you have to um, have about 30-ish grand or more in deductions, depending on just your age, really. So just something to keep in mind if you do regularly take the standard, but a good option if you're looking to reduce your income. I also want to touch a little bit on trusts because I don't think everybody needs a trust. I think it's for just really specific circumstances. So a trust does completely avoid the probate process, and probate is a completely public process. So if you want to maintain your privacy, that's definitely one reason to get a trust. I think the biggest reason that people look into trust is just to kind of preserve their assets. They want to control those distributions over time because you can provide very specific instructions in a trust. You can state that you want your children to only get disbursements when they reach certain ages, or they can only spend money for things like tuition or medical expenses, or if you just want your kids to have a fixed monthly income every single month where no increases are allowed, you can state that too. So you can really just tailor it to however you think is best. Another advantage for having a trust is it does protect your heirs from any creditors or divorces. So any assets that are left to an heir can potentially be seized by creditors or bankruptcy courts or maybe a divorce settlement. So by leaving assets inside a trust, that money belongs technically to the trust and not the heir, which safeguards the inheritance from any legal claims. So that also gets into, kind of protecting any blended family dynamics. So if you have kids from a prior marriage, a trust just ensures that they are protected. And then, of course, if you're trying to minimize any estate and income taxes, there's a lot of different types of trusts out there, but for minimizing your estate taxes specifically, you would want an irrevocable trust because irrevocable trusts are not included in your taxable estate because you're basically giving up ownership to the trust. You're giving up control to the trust per the instructions. But tying that into charitable giving, because this again all goes into reducing your estate tax bill and just maximizing what you can give to the next generation, there are two main types of charitable trusts. So we have a charitable remainder trust or CRT. This is perfect for donors who might have highly appreciated assets, but they are kind of like low income producing. So basically, a donor transfers property into the trust. The trust pays the donor an income stream annually, either for that donor's lifetime or for a specific term, a specific amount of years. And when the trust terminates, those remaining trust assets are transferred to the charity of their choice. Now, the advantages with this is that you do get an immediate tax deduction for the projected value of the assets that go to that chosen charity. And because these trusts are completely tax exempt, the trust can sell appreciated assets without realizing any capital gains taxes. So just to recap, any assets placed in this type of trust are completely removed from the donor's estate, which potentially reduces your estate tax liability. Another really common charitable trust is going to be the charitable lead trust. So this is perfect for families who are really focused on preserving multi-generational wealth, as well as giving. So again, a donor transfers this property into a trust, but instead the trust makes annual payments to a qualified charity first for a specific amount of time. Now, what that's doing is charitable donations are allowable deductions from your estate. So it's helping kind of lower that taxable estate ahead of time. But when the trust terminates, the remaining trust assets are transferred to the non-charitable beneficiaries, so your heirs. Now, the present value of any of the charitable payments does reduce any taxable value you have of any remainder gifts, which essentially enables the donor to transfer more wealth to people while using less of that lifetime exemption, while using less of that $15 million exemption. So there's a couple of different types of these CLTs. You have your grantor CLT, where the donor does receive an immediate tax deduction, but the trust income is reported on their tax return. And then you also have a non-grantor CLT. So there's no upfront deduction, but the trust deducts the charitable payments each year and also pays tax on any income earned within the trust. So there are a couple other types of charitable trusts out there, but these are just the most common that you definitely hear of. But that kind of summarizes everything that I wanted to go over today. So if you were ever interested in seeing any of my other blog posts, you can just go to jessupwealthmanagement.com, or you can scan this QR code. And then I think Jenna was going to talk a little bit about doing a Q&A if anybody has any questions.